Vancouver-based Doman Building Materials, formerly known as Canwell, beat profit estimates in its latest quarter. We are joined by Amar Doman, Chairman of the Board and CEO at Doman Building Materials. Thanks very much for coming on, Amar.
Thanks very much for having me.
We keep hearing about weakness in the housing market, but you managed to beat profit expectations in the latest quarter. Your EBITDA coming in above expectations. What caused that? What contributed to the strength?
Well, despite all the bad news that you see in the markets and in the newspapers, et cetera, and the media, we haven't really seen the slowdown. In fact, our sales rocketed up in the third quarter, surprised ourselves as well. But we're, getting prepared for obviously a slowdown coming. U.S. mortgages are north of 7% now. So we think there'll be a bit of a slowdown next year. But having said that, we're not directly tied to new housing. Under Doman Building Materials, of course, we're in a lot of repair, renovation markets, backyard stuff, and the like. So we're a little bit mixed when it comes down to the exact pulse of new housing.
Your gross profit margin, though, did slip. There was some weakness in construction material pricing.
There was, and certainly that's not something we can avoid. We had some great runs, some big ups and obviously some downs. But managing through that, I think our gross margins held very well, through quite a downdraft of spruce lumber and everything else kind of falling out of bed, if you will. At the start of the third quarter, we managed through that, and now we're back on sort of steadier ground now as we're in the fourth.
And just remind us what you do at the company. You distribute building materials, but what else?
Yeah, so a few things. So in Canada, we distribute building materials. We have 33 lumber treating plants now, almost 3,000 employees across Canada, the U.S., and Hawaii. We have now our revenues would be about 65% almost U.S. So we're pretty much a U.S.-based company now. We're built out in Canada pretty well, but we distribute all different product lines and of course, produce a ton of pressure-treated lumber, which is our main focus.
Oh, so you're about, 60% or more in the U.S. now?
Correct.
Tell us about this sale, Lowe's pulling out of Canada, selling off their Canadian stores, more than 400 to a U.S. private equity crowd. Why do you think Lowe's is doing that?
Yeah, we saw that the CEO, Marvin Ellison, do a couple of different things. Number one, he sold off the Mexican operations, a little while ago. He closed and sold Orchard Supply, which is a California-based, retailer that they owned. Canada was sort of the last sort of non-U.S. focused asset they had. So it wasn't a big surprise to us. We're happy somebody wanted it, and we'll, continue to build, the retail space here in Canada. So we're very happy with it. They're a big customer of ours, of course, as are others in Canada. But the U.S. seems to be the focus for Lowe's only now.
Why, did they have trouble in Canada? Lowe's just earning the return that they wanted?
I'm not sure. There was a build out there, and of course the acquisition of Rona. I think they just have elected to become U.S. focused, period, and that's the strategy. And everything else internationally has been divested.
What about yourselves? Are you on the acquisition trail right now? Are you looking for things to buy?
We always are. And, a couple of things, Andy, that we look at. Number one, we look at valuations. And, we've all had a pretty good, repair and renovation run the last couple of years here, including ourselves. So we look at some of the valuations. We don't agree with them right now as far as multiples on buying these assets. We're a very acquisitive company. We will continue to buy more companies, primarily in the U.S., but valuations need to sober up, in my view, and then we'll take a look.
I'm looking at a yield here north of 9%. I haven't on your stock. I haven't had time to check out your dividend policy, but do you pay a regular dividend?
Yeah, we just announced yesterday that's the 50th straight quarter of a dividend. We were an income trust way back when in 2010, converted back out, but 50 straight quarters of dividends. So our yield does bounce around a bit because we're an industrial company, so it does move. But we like where we're sitting today. You'll see us all buying stock. We're pretty happy with the discount that's been provided to us, but our dividend's very safe. Yeah,
because I have you down for a regular dividend quarterly of 14 cents, and then I think you pay special dividends occasionally.
Well, yeah, once in a while we will pay a special dividend, but 14 cents is the marker, and I believe our payout ratio this year will be in the 30% range.
What's going to be next for you guys? I mean, you say the renovation market is very important. Of course it is. But presumably as rates go up and housing valuations fall, that's going to put pressure even on the renovation market. I mean, people won't be fixing up their house to sell to the same extent, perhaps.
So a couple of things. What we're really focusing on is our balance sheet. So our balance sheet's never been in better shape. We have over 300 million of open credit available to us. We reduced our debt by 100 million year over year. We did a large acquisition, Texas-based last year. So we're really paying attention to that. We know that the wheels are going to come off a bit on new construction. There's just no question about that, whether that's Canada or the U.S. We are encouraged by 500,000 immigrants coming into Canada now. In the next 3 years, they're going to need a roof over their head. So we see multis being strong over the next couple of years, single family slowing down, no question. But for us, we're in good shape. So that repair and renovation market will always be around. I've been through 3 recessions in my career. Repair and renovation always bodes well through tougher times, when money is costing more like it is today. So we'll be fine. We're just going to probably slow down a little bit next year, but we're in great shape.
And just finally, we've only got about 30 seconds. It looks like you have a fair amount of debt. The latest rating I saw from Fitch was single B, so that's below investment grade. So you have a fair amount of debt on the balance sheet?
We would say a fair amount. We're certainly not over-levered in our view at all. We have a revolving credit line, so it's our credit card to run the business on working capital. So we've got 300 million open right now, and our debt to EBITDA ratios, bounce between 2.5 and 3.5, and that's kind of where we live, and that's where we've been for a long time. So we're not concerned about our debt levels whatsoever.
Oh, okay.